For the first time in modern financial history, gold has overtaken the euro as the world's second largest global reserve asset. Not a forecast, not a projection, something that just happened. And the number that marks this moment is $5,030.90, the current spot price of gold as of this week. If you are holding gold right now, I want you to understand exactly what this milestone means, what it changes structurally, and what it absolutely does not guarantee, because both of those things matter more than the headline. Last week I told you to watch the CME warehouse report for registered silver inventory, specifically whether it held above 80 million ounces. The number came in at 83.2 million ounces for the week, which means the floor held. Open interest on the May silver contract declined as traders rolled positions without standing for delivery in large numbers. Exactly the quieter resolution scenario I flagged as one of the two possible outcomes. The squeeze risk did not evaporate. The underlying conditions have not changed. But this specific cycle resolved without a forced delivery event. I called that level publicly. It held. That is the accountability loop, and it runs every single week on this channel. My name is John, 15 years in currency and commodity markets before I ever picked up a camera. I have watched reserve allocation shifts happen in slow motion before, the kind of moves that look obvious in retrospect and nearly invisible while they are actually occurring. What is happening in gold right now is one of those moments. I left institutional markets because I believed retail investors deserved the same quality of analysis the institutions were working with. That is what we build here at Currency Insider. Everything I show you today comes from publicly available data, and I will name every source as we go. Today we are covering three things. First, what it actually means for gold to overtake the euro as a reserve asset, and why this is a structural event rather than a market sentiment story. Second, the specific price dynamics developing right now, including a persistent Shanghai premium above $100, and what that tells us about where the repricing is being led. And third, how I'm reading this through the three lanes framework this week, plus the one specific level I am personally watching that will tell me whether gold's next move is a continuation or a pause. If this kind of calm, evidence-based breakdown is what you have been looking for, hit the like button right now. It genuinely helps this channel reach the people who need it most. And if you are not subscribed, now is the time, because what we are tracking today is a multi-year story that we will be building week by week. Let us get into it. Gold is trading at $5,030.90. The dollar index, the DXY, is sitting at 99.98. That is a significant number in its own right, because the DXY breaking and holding below 100 is historically associated with dollar softness that tends to be supportive for gold. The U.S. 10-year Treasury yield is at 4.25%, and Shanghai gold spot is running at approximately $5,131, a premium of roughly $100 over the Western price. Same metal, different market, different price. We covered this dynamic in detail last week with silver. With gold, the same question applies, and the same analytical discipline applies too. Let me give you the right framework before we talk about the headline number, because the headline number, gold overtaking the euro, is genuinely significant. But it requires some careful unpacking, or it becomes just another dramatic claim. Here is what it means precisely. Global foreign exchange reserves, the assets that central banks hold as their financial backing, are measured and reported by the International Monetary Fund. For decades, the composition of those reserves has been dominated by the US dollar in first place, the euro in second, and a collection of other assets, sterling, yen, renminbi, and gold, making up the remainder. What the most recent IMF reserve composition data shows is that gold's share of allocated reserves has grown to the point where it has now displaced the euro from that second position. That is the milestone. And before you dismiss it as an accounting technicality, I want to be very clear about what makes this different from previous gold rallies. Quick question before we go further, and I genuinely want your answer in the comments right now. Are you currently holding gold in physical form, in an ETF, in a mining stock, or in a pension, an IRA if you are in the US, a SIPP if you are in the UK? Drop your answer below. The comment section here becomes a real-time picture of where our audience actually is, and I read every single one. Here is what makes this moment structurally different. In every previous major gold rally, 2008, 2011, 2020, gold rose primarily because investors were frightened. It was fear-driven, safe haven demand. The moment fear subsided, gold corrected. What is happening now does not look like that pattern. The U.S. 10-year Treasury yield is at 4.25%. That is not a low-yield environment. Historically, gold struggles against nominal yields at that level because a Treasury that pays 4% is competing directly with gold, which pays nothing. The fact that gold is at $5,000 despite a 4.25% Treasury yield is the most important sentence in this entire video. It means buyers are not choosing gold because they have no alternative. They are choosing gold despite having a relatively well-paying alternative. And when I look at who is doing the buying, the World Gold Council's most recent central bank survey data makes this very clear. It is central banks, not retail, not hedge funds, chasing momentum. Central banks. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into gold at $5,000 per ounce, that is a multi-year institutional decision made at the highest levels of monetary policy. That is a completely different kind of buyer than a retail investor who got excited after watching a YouTube video. And that distinction matters enormously for how you think about the durability of this move. Think of it this way. Imagine two buyers at an auction. The first buyer is nervous, has a short memory, and will sell the moment the mood in the room changes. The second buyer is a pension fund that has just made a 20-year allocation decision. Both buyers push the price up on the day, but only one of them is going to be there next year. Central bank gold buying is the second buyer. That is why reserve composition shifts move slowly and hold. Now let me give you the Shanghai side of this because it is directly connected to the reserve story and it is being underreported. The Shanghai premium, gold trading approximately $100 above the Western spot price, has been persistent for weeks. The same caveat I applied to the silver premium last week applies here. Premiums can reflect Chinese import structures, VAT, currency conversion mechanics, and local demand dynamics that are distinct from pure Western supply signals. I am not going to tell you the $100 premium means gold is really at $5,131 everywhere in the world. That would be sloppy analysis. What I will tell you is this. A persistent premium of that magnitude in the world's largest physical gold market does not maintain itself without real underlying demand. It can spike for structural reasons and then normalize quickly. When it persists for weeks, that is a different signal. The LBMA, the London Bullion Market Association, which is the settlement backbone of the global gold market and one of the most important benchmarks for UK investors in particular, has been showing elevated vault activity in its most recent published data. I am not going to overstate what that means because vault flows have multiple interpretations, but the directional signal from London, Shanghai, and the IMF reserve data is pointing the same way. And I want you to hear the honest version of the other side as well, because there is a genuine bear case here, and it deserves equal time. Stop. Before we go into the macro layer, I want to show you something in the data that actively argues against the most aggressive bullish interpretation. Because if I only showed you the bullish case, I would be doing exactly what every other channel in this space does. The US 10-year yield at 4.25% represents a real cost to holding gold. Real yields, which you calculate by subtracting expected inflation from the nominal yield, have been pressured by energy-driven inflation, according to the most recent Bureau of Labor Statistics data. That energy component is the specific driver keeping real yields negative enough that gold remains attractive. Here is the risk. If Middle East tensions see a genuine resolution, a peace development that brings energy prices down meaningfully, the inflation component of that real yield calculation changes. The nominal yield stays the same, the inflation drops, real yields rise. And historically, rising real yields are the single most reliable headwind for gold. The article I am working from this week puts the potential support test in that scenario at $4,900. That is a 4% correction from current levels. That is not catastrophic for a long-term gold holder. But it is worth understanding as the specific mechanism through which a pullback would most likely develop. I want you to have that framework, not as a reason to sell, but as a way to understand what you are watching for. If you know someone in your life who has been trying to make sense of gold at $5,000, a family member, a colleague, someone in your investment club, share this video with them right now. This is exactly the kind of context they are not getting from the financial press. Now, let us bring in the dollar layer, because it is inseparable from the reserve story. The DXY at 99.98 is not a collapse. I want to be very clear about that. The dollar is not disappearing. What a DXY reading below 100 represents is a softening, a gradual reduction in the dollar's relative dominance that, when combined with the reserve composition shift we just discussed, starts to form a coherent picture. The Congressional Budget Office's most recent long-term fiscal projections show U.S. deficit spending on a trajectory that is mathematically significant regardless of your politics. I am not making a political statement. I am reading a government document. When you run persistent deficits at the scale the CBO is projecting, the credibility of the currency that those deficits are denominated in becomes a live question in global markets. And the article I am working from this week uses a phrase I think is exactly right. A credibility event is being priced into the dollar, not a crash, not a collapse, a credibility question. And gold, historically, is how markets answer that question. For UK investors specifically, and I want to make sure we address this directly, the dynamic is amplified by two things. First, sterling weakness means that gold priced in pounds has seen an even more dramatic move than the dollar chart suggests. When both the dollar and sterling are softening relative to gold, gold's function as a portfolio anchor becomes more visible and more urgent. The Bank of England's current reserve posture and its published commentary on currency stability are worth tracking for UK viewers who want to understand the institutional backdrop. Second, and this is worth considering for anyone holding gold inside a SIPP, the question of allocation sizing becomes more important as the price rises. The same percentage of your portfolio in gold at $5,000 represents a very different exposure than it did at $2,000. That is not a reason to reduce. It is a reason to be intentional and explicit about what role gold is playing in your specific situation, which is a conversation for your financial advisor, not for this channel. On the industrial and technology demand side for gold, and this is a smaller part of the gold story than it is for silver, the semiconductor and electronics applications are real, but they are not the primary driver here. The primary driver is monetary. That is what makes this cycle different from the silver story, where industrial demand is a major structural component. Gold's story right now is almost entirely about reserve allocation, monetary credibility, and central bank behavior. All right, let me show you how I am actually thinking about this week using the three lanes framework. This is how I separate what is noise from what actually matters. The paper market lane, the blue lane, is telling me gold futures positioning is elevated but not at historical extremes, according to the most recent CFTC commitment of traders' data. The DXY breaking below 100 is a technically significant level that algorithmic trading systems are watching. The nominal yield at 4.25% is the key paper market variable this week. Any meaningful move in that number will transmit directly into paper gold positioning. The physical market lane, the silver lane, which I use for the physical precious metals signal regardless of the metal, is telling me Shanghai premium persistent above $100, LBMA vault activity elevated, central bank buying documented and ongoing by the World Gold Council. The physical lane is telling me demand is real, broad-based, and not primarily speculative. The macro lane, the gold lane, is telling me dollar softness documented in the DXY, fiscal trajectory confirmed in CBO data, reserve composition shift confirmed in IMF data. The macro lane is the strongest of the three this week. All three lanes are pointing in the same direction. In 15 years watching currency and commodity markets, the times I have seen all three lanes align, paper positioning supportive, physical demand genuine, and macro backdrop reinforcing, have historically been the setups where the move has more duration than most people expect. I am not telling you gold goes to 6,000 next month. I am telling you the conditions that produce sustained moves look more like this than they look like anything else I have tracked. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week, not three things, not five. 1. I am watching the U.S. 10-year Treasury yield, specifically around the 4% level. Here is why that level matters right now. If the 10-year yield breaks below 4% and holds there, real yields drop further, and the cost of holding gold versus treasuries narrows. That removes one of the most credible arguments the bears have been making. If the yield holds above 4% and starts drifting higher toward 4.5, watch for paper gold positioning to face some pressure as the opportunity cost of holding gold rises. The Treasury yield data is published continuously and widely available. The specific level I am watching is 4% on the 10-year. That is my line this week. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what the optimistic picture requires. Central bank demand remains price insensitive, meaning the buyers who got gold to $5,000 keep buying at $5,000 or above. The DXY continues softening. Real yields stay pressured by energy inflation. The Shanghai premium holds. And the next technical level the market is watching, $5,200 according to the analysis I am working from, gets tagged and holds as support rather than resistance. If those conditions develop in sequence, the bull case is well documented. Here is what the cautious picture requires instead. A genuine resolution in Middle East tensions brings energy prices down. Inflation softens. Real yields rise. The DXY stabilizes or recovers toward 102. Central banks slow their buying pace, not stop, slow. And the paper market, which has been supportive, starts to see some unwinding. In that scenario, a test of $4,900 is the specific level to watch. Both pictures are genuinely possible right now. I want to say something directly to anyone watching this who is thinking about adding to a gold position at $5,000. The question is not whether gold is overvalued or undervalued at this price. The question is what role gold plays in your specific situation and what time horizon you are operating on. A central bank buying gold at $5,000 has a 50-year time horizon. A retail investor who needs liquidity in 18 months has a completely different calculation. Your job is not to match the central bank. Your job is to understand your own position. The market will tell you what the conditions are. You have to decide what those conditions mean for you. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, when you heard that gold has overtaken the euro as the world's second reserve asset, what was your immediate reaction? Did it feel significant to you, or did it feel like a number that does not connect to your real daily life yet? Second, and this one requires the framework we built today, if real yields start rising because energy inflation cools and you are a long-term gold holder, what would you need to see to tell you the structural bull case is still intact versus being broken? Drop both answers below. I genuinely want to know where you are. Subscribe because next week I am going directly into the history of dollar DXY breaks below 100. Every time it has happened in the last 30 years. And I will show you exactly what followed in gold, silver, and broader commodity markets each time. That historical pattern is one of the most useful tools you can have right now, and we are going to build it together. And if someone in your life is sitting on a gold position right now and trying to understand why it is at $5,000, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.